Good afternoon, ladies and gentlemen. Of course, as always, I'm saying good afternoon to those of you who are joining me here on the East Coast. I also want to say good morning to those of you who are joining us from the Central Time Zones, Mountain Time Zones, or the Pacific Time Zones. And of course, I want to say good evening if any of you are joining us from across the pond in parts of UK, parts of Europe, and of course, good early morning for anyone who's joining us in the parts of Asia and parts of Australia as well. All right, Jerry says that the sound is good and the screen looks good. Fantastic, Jerry. Thank you for that. Welcome to today's presentation. We're going to cover the basics of calendar spreads, and we want to go through some of the different structures and the different setups of the calendar spreads. We're going to follow that up in a couple the next 2 weeks, of course. We're going to follow it up with more in-depth criteria discussion on trade selection and also management, but we may cover some of those ideas today. For those of you who don't know me, though, my name is Mike Chupka. I'm the Director of Education here at PowerOptions. PowerOptions, of course, is a patented suite of search and analysis tools designed for self-directed options investors. Ernie Renner created PowerOptions back in 1997, so we've got about 20 years of experience in business with the options platform and our patented search and analysis tools. But everyone here on staff, myself included, use these tools to trade their personal accounts. So we have many more years of combined trading experience. Well, again, today's discussion is going to focus on calendar spreads. We want to introduce what is a calendar spread, how can one structure a calendar spread, some of the pros, some of the cons, and some of the misconceptions, and the basic and intermediate concepts of what to look for and what to look out for. Now, a calendar spread. The standard definition of a calendar spread is any combination of calls or puts where one option is sold and the other is purchased. So we're selling one call and buying another call, or we're selling a put and buying another put. But the options will have a different expiration date. Now, the combination might be called a calendar call or a calendar put, but this standard definition leaves things wide open, doesn't it? The standard calendar call, the definition might be to sell to open a near-term call under 30 days out in time, and buy to open a far call 3 months or more out in time. Or if you're using weeklies, you might sell a call 1 week out and buy a call 2 weeks out or 3 weeks out. And then a calendar put, of course, you're going to sell to open a near-term put and buy to open a farther out put as well. The expiration dates, a common question now where we have about a little bit more than 1/10 of all optionable stocks, ETFs, and indexes now offering weekly options. So the common question when an investor starts to delve into calendar spreads is what expiration dates to choose. Well, you can use weekly versus weekly. Almost all of the weekly securities out there, securities that offer weekly options, now offer expirations up to 5 weeks out in time. This means I could sell a call or a put that expires on Friday, and buy one that expires on March 10th, standard expiration of March 17th, March 24th, April 1st, and so on. Okay? You can use weekly versus monthly. I could sell an option that expires on March 10th and buy one out to June or out to September. You can use weekly versus leaps. A lot of investors originally were introduced by the calendar spreads or calendar leap positions, where gurus would teach that you want to buy a leap, you want to buy an option as far out as possible, 1 year out or 2 year out. Right? We have January 2018 series available right now. We have January 2019 series available right now. And in a couple months, we'll see the 2020 start coming out on some of the stocks as well. Now, we'll show this later on with the profit and loss charts, but I typically don't recommend a weekly versus a leap. And the reason why is because if I'm buying that far out in time and paying so much money, whether it's an out of the money, or in the money option, going out to January 2018, and I'm selling something that's only generating 40 or 30 or 20 cents with a 7-day or 10-day trade, unless I'm planning on continually writing the position for multiple weeks, the initial profit and loss chart probably won't match my goals, but we're going to talk about that too. Now you can use monthly versus leaps. That was the original most common one before the weeklies were introduced, right? I'd sell a monthly, maybe a March 17th that has 17 days out, or maybe in April, call or put against the position, and I'd buy a 2018 leap. Some investors use leaps versus leaps. That might not be worth it as well. So there's any expiration date is viable, but we're going to talk about that too. Why you'd use one over the other. Now, the standard definition is very basic. And there's a whole bunch of expiration cycles that we can talk about. But what all of that leaves out is the proper nomenclature. Now, just like any option strategy, you can set the strikes any way you want. They can be in the money. They can be out of the money. They can be at the money. And they can be at different strike prices. Okay? The structure of how you set it up is going to define what kind of calendar spread that you're in. Now, let's define this. Calendar spread, we've already talked, is any combination of selling a call and buying a call with different expirations. Or it could be selling a put and buying a put with different expirations. But the way you structure the trade defines what type of calendar spread you're in. Now, a horizontal spread. It's commonly called just a calendar, but a horizontal spread, I break it down differently. To me, a calendar is any combination of calls and puts that you're selling and buying, different expirations, same strikes, different strikes, what have you. A horizontal is a combination of selling a near-term type, typically a near-term option, and buying a farther out option of the same type, call or put, where both options have the same strike. We're looking at a stock trading at 50. I might sell a March 50 call and buy a June 50 call. Okay, that would be a horizontal. We keep the same strike, but one's further out in time. The diagonal spread, typically the most common, is when an investor sells an at or out of the money option near term, a call or a put, and then buys an in the money option farther out in time. This can be reversed. We'll talk about that as well. But generally, what we're looking at with a diagonal, our stock at $50, I might sell a 50 or a 52.5 March call. And then I'm going to buy maybe a June or a September 50, a 45, or maybe even a 40 call, depending on what structure I want as far as the delta goes, my protection goes, and what my goals are for the position. As I mentioned, this can be reversed. An investor could sell a June call and then buy, so for example, sell a June 52.5 call and buy an April or a March 55, 57.5, or 60. We'll explain all of that, why you'd use one over the other as well. And in general, the reversals are exactly what they say they are. You sell far out in time to buy near term. I don't recommend this. We're going to discuss it. This sets it to be done at a credit. Horizontals and diagonals are typically done at a debit. So it is a debit spread. That allows us to avoid the margin or the monetary requirement you might see in a credit spread, such as a bear call or a bull put in the verticals. Okay? All right, so let's look at calendar calls, and we'll relate this also to calendar puts as well. But regardless of which structure you choose, horizontal, diagonal, reversal, we always have to remember two things: the rights and obligations of the actions you took to enter the position. Entering a spread trade, and that's what a calendar is. It's a debit spread essentially. But when we enter a spread chain, we don't change the obligation that we have for selling an option or buying an option. We still have those rights and obligations available to us, but we have to remember that. When I sell a call, I've entered into an obligation to potentially deliver shares of stock. In this case, shares of stock I do not own. Now, when I buy a call, I have the right to purchase the shares of stock at a particular strike price. But it's important to keep those in mind. Yes, the structure of the trade is going to give us a reasonable profit and loss chart. We're going to evaluate that as well. But we never can forget that we still have an obligation, just as you do in a covered call, to deliver shares of stock. And when you sell a put, If you do a calendar put spread, if you're selling an at-the-money or an out-of-the-money put option, remember, you have an obligation to buy shares of stock at that strike. Okay? That is a potential outcome of the spread. You may end up owning shares of stock if you don't manage it appropriately in a calendar put. All right, first, let's delve into horizontals. Jerry, I'm going to get into which one I favor in just a little bit. Just bear with me, but I'll cover that. In truth, I'm sorry, I'll address it now. In truth, I favor the diagonals, but I want to cover the horizontals too, and I'll explain why I favor the diagonals. So the horizontal spread, at times just called a calendar, an investor is going to sell an at-the-money near-term call and buy the same strike further out in time. You can also sell an in-the-money call and buy an in-the-money call that's further out in time or out of the money as well. That's going to depend on your sentiment for the stock going forward. Let's take a look at an example of a horizontal calendar. Dick's Sporting Goods right now, trading this morning at around 50.25. To enter a horizontal, I would sell to open the 2017 March 50 call for $2.50. And at the same time, I'd buy to open 2017 June 50 call, same strike, for $4.30. Now, this gives me a total net debit of $1.80, and my maximum profit is going to be around 202, or 112%. All right, let's take a look at that profit and loss chart. A horizontal spread gives us sort of the A-frame profit and loss chart. Maximum profit is always realized on a calendar spread, whether it's a horizontal or a diagonal, if the stock is trading right at your short option strike price, the strike price of the option that you sold at short-term expiration. The horizontal spread will likely always give you an upper and lower break even. We have two ways to lose. We can lose if the stock falls. In this case, our lower break even would be about 45.36 at March expiration. The upper break even in this case was at 55.62 if the stock moves up. Now, remember, I sold a 50 strike for March and I bought a 50 strike for June. How can I profit if the stock's above 50? Remember, I sold an option that obligates me to deliver shares of stock at 50. And I bought an option which gives me the right to buy shares of stock at 50. So what many of you may be familiar with a covered call, if the stock's above our strike, we get assigned. We make the maximum return anywhere above there. How can I make a profit if I get assigned where I can essentially buy shares of stock at 50 and sell them at 50, and I paid a debit of 180? Where's the profit? This is where things get tricky with the calendar spreads. Okay? What we have to keep in mind is that the theoretical profit and loss of a horizontal spread is based on what our long call would be worth, our June call that we bought, if the stock was trading at these prices at expiration, and based on what we receive or what we have to pay back for the short option. So if the stock's at $51 at March expiration, let's call it right here. It's a terrible one. Let me clear this up and give us a better line there. So we'll call it right about here. Let's say 51, okay? What would happen? Well, I'd have to buy to close or adjust my 50 call. But let's say I buy to close it. I have to buy to close it at $1. How am I making a profit of about $170? It's because the 50 June call would theoretically still be worth $3.50. And I collected $1.80 against it. Remember, we paid that debit of $1.80. We have to pay $1 back, and then we could sell to close the long call, and that would be the profit. How do I lose on the upside? Well, remember that rule of expiration. If you have an in-the-money call at expiration, the short-term expiration, the delta goes automatically to 1. Even though the stock is continuing to move up, the delta of our long option is not at 1. It's not going to reach 1. This magically goes to 1 at expiration. So if the stock's at 55, we'd have to pay $5 to buy to close our March call. If it's at 60, we'd have to pay $10. to buy to close the March call. Be right at intrinsic value, maybe a little bit extra. Meanwhile, this delta of our June option is not at 1 yet. Okay? So what can we grasp? What can we glean about this particular structure and why we would use it? Clearly, that is a neutral strategy. Your max profit is made if the stock's trading right at the short option strike price. You'd only do this on positions that you feel neutral. You want the stock to stay at or near the strike prices of the options, really the short-term option in this case. But, since it's the same strike spread, we're looking at the same ones. We can lose if the stock gaps up or down, okay? And our return is going to be based on the theoretical value of the long call at short-term expiration, okay? What is the goal of a horizontal spread? Well, it's to make money, obviously. But a typical horizontal calendar investor is looking for rapid short-term time decay. I want that near-term option to decay rapidly so it costs me less to buy it back, and have a slower time decay on the option that's further out in time. I want it to retain more of its value as we pass the next 7, 10, or in this case 17 days to our short-term expiration. Most horizontal calendar investors I talk to are using this as a one-time trade. They probably wouldn't consider rolling the position. They're looking at it as a neutral position where in our example for Dick's Sporting Goods, DKS, they do not think it's going to be trading much above 50 or much below 50 as well. It's a neutral position. When they get to expiration, they will most likely close out the long option and let the short expire or buy it back for a cheaper price if it did what they want. Now, of course, if the stock starts to move up against them quickly as soon as they open the trade, they may look to adjust it or exit it. But in my experience and the conversations I've had over the last 17 years I've been working here at PowerOptions, most investors who are doing a horizontal are looking at it as a one-time trade. All right? Now, let's talk about that as a horizontal, as a one-time trade, as a theoretical positioning. Okay? With this in mind, the goal of the position to have that short option rapidly decay and have our long option retain most of its value if possible means that we want to have a higher time value in the short option and the longer option to have a lower time value or lower implied volatility. Now, we're not going to necessarily see a lower time value on the far out option just by straight definition. Theoretically, that's what we want, but it's not going to happen. So what we want to focus on is we want the shorter term option to have a higher implied volatility and to be inflated. And the longer option that we're buying, the farther out option, we want to have a lower implied volatility. Okay? So for DKS, our March 50 call at the money has an implied volatility of 0.592. And our June 50 call has a lower implied volatility, right? 0.3855. This would work in our favor for a horizontal spread. We want to see an IV collapse, or what's sometimes called an IV crush, but we want the implied volatility of the short option to fall faster and the time value to decay rapidly on the shorter option. This structure would give us an implied volatility ratio of 1.53. Over the next 16 days to March expiration, I want to see a rapid time decay of that 220 in time value for the March 50 call. And I want to lose less in the first 16 days on the June, which has a time value of 415, 412, but has 107 days to expiration. All right. Now the strategy of a horizontal profits from IV crush. So when we see an implied volatility crush in the short term, meaning that as we get closer to expiration, the implied volatility of that shorter option is reverting back, falling back down to maybe 0.40, maybe 0.38, where our long option is. That's going to help us with that rapid time decay. But the key is to remember is although you want an IV crush, think about the structure of the trade we just looked at. We know it's a neutral position. We want the stock to be trading right at the same strike at our short-term expiration, whether you went 3 days out to Friday, a weekly, whether you went 10 days out to March 10th, or whether we went 16, 17 days out to March 17th, okay? We want the stock to be trading right around our short-term strike price. But if you have an event coming up and the options look inflated, remember that if you see an IV collapse because of the event before your short-term expiration, well then, you're going to see an IV collapse on the long one as well. Remember, the long option is what you're invested in. Yesterday, a customer asked me about a weekly spread. They were looking at a weekly horizontal. They wanted to sell the 3-day out Friday at the money, which had an implied volatility of 0.99. Some of you might call 99%. And they wanted to buy the further week out, March, at the money strike, which had an IV of 0.70. Now, they expected a crush in the short term before Friday expiration and see that 0.99 collapse down to maybe 0.5 or 0.4. But if something happens that calls an IV crush on the 3-day out option, it is also going to affect the farther out option. And this isn't that far. The next week out, 10 days out, that 0.7 might drop to 0.3 as well. And that's where your money is. That's what you invested in. You lowered the investment by selling the near-term call. But if the crush on the farther option is more, you can still be in a losing position even with a profitable or what looks like a high percentage volatility collapse. So what would be better in that structure is maybe selling the Friday and then buying an April or a May or a June, which won't be as affected. Okay, now, why did I choose this initial example for DKS with the horizontal? Selling the March 50 call, and buying the June 50. Looks like a very profitable horizontal spread. We saw a debit of 180 to make a profit of 112%. It's around 202 based on the theoretical prices. There was an upper and lower break even, but it was a 10-point range. Remember, 45.32 was our lower break even where we'd start to lose money on the spread, and on the upside it was 55.62 or so. So we've got about a 10-point range to an upper lower break even. So why does the spread look so good? Well, it's because earnings are coming up on March 7th, before the short-term expiration of March 17th. I chose this specifically to illustrate that even though you have what looks like a very strong profitable position, you can find horizontals with 80% potential returns, 90% potential returns, and more. But we saw based on the profit and loss chart that this is a neutral position. This is not something that you'd want to be in where you have earnings coming up before the short option expiration. Dick's Sporting Goods could drop 5 points below 45, a 10% drop. It could drop 20% and we're at a loss. And remember the lie of leverage. Okay, we might make a profit of 112%, but that's if and only if the stock's trading right at the short-term strike price. When we start to lose profit, it moves up and down. And again, if it goes to the wide side one way or the other, which could happen because we have earnings coming out, that is not a position that I would enter strategically, okay? And I know, you're saying, why would you show us a position you wouldn't get into? Because we want to talk about what you would look for, what you might do, and what you might not do. The horizontal spread is not a position to trade around earnings. Yes, you can get a good implied volatility crush. Yes, many investors will try to look for positions that have a high implied volatility on the short option and a lower implied volatility further out in time to take advantage of that implied volatility crush to profit. However, if you set your strike too close, both options are going to be drastically affected. If you're playing it because the implied volatility is increased to where you have an earnings date between now and the short-term expiration, well, the wild swing, the effect of it, even if you get the implied volatility crush that you want, you might not make a profit. If Dick's Sporting Goods moves up to 57 because of a good report, I'm at a loss, regardless of the implied volatility crush in my favor or the rapid time decay of the short option. And if the stock collapses to 42, I'm losing money as well. Okay, so it's a double-edged sword, looking for a high implied volatility ratio for a horizontal trade, or looking for any kind of structure in that fashion where you have a high IV ratio between the sell option and the buy option. You have to know why that exists. And if you're setting yourself up with a neutral profit and loss chart, that letter A profit and loss chart, if the event is for earnings, or potentially worse, if you're looking at a phase 2 or phase 3 trial on a biotech, the structure and potential profit on the trade might not be worth it because you're taking the chance that if there's a wild swing, you're going to lose. Okay? Now we showed the ATM structure, which is, I believe, the most common for those of you who might be interested in the horizontal spreads. Right? You're selling right at the money to maximize the time value of your short option, and you're keeping the same strike with the farther out option. You can do a same strike spread going in the money or out of the money, but it changes the dynamic. The at the money spread we showed was neutral. If I sell in the money calls or in the money puts, for example, on a horizontal spread, that's, well, the in the money calls, I'm sorry, is going to create a bearish position. An in the money horizontal put spread, calendar put spread, would create a bullish sentiment. And then using a horizontal call out of the money, where both calls are above the strike price, that's a speculative bullish position, excuse me. And if I did out of the money with the puts, that'd be speculative bearish. Let's pause for a moment. I'm going to navigate over to Power Options. I'm going to show you what I mean, taking a look at our 3 structures for DKS, just as an example, and we'll take a look at our various positions. Now, I had a question come in a moment ago. I'm sorry. It was from Indra. Indra wanted to know, is this recorded? Yes, I am recording today's presentation. It'll be available in the free webinars section of Power Options later today, and I'll send a link to everyone for that. It's poweropt.com/webinars.asp. We will let you know when it's posted. All right, so what I'm going to do now is just go to the custom spread tool in Power Options. Make sure everyone's seeing what I'm seeing. Fantastic. And we're just going to structure our original trade. Prices have sort of shifted here a little bit. Let's look at that 50 call for about 230, I believe we said it was, and then the June 50 call for about 420. So I'm going to sell this at 130. I'm sorry, not 130, it's 230. And we're going to buy this at about 410, let's say. Okay, that'll give us that debit of 180. All right. So again, if I select sell, it would work great, huh? There we go. Here's our horizontal spread for DKS. And again, we sold the March 17th. I want the stock to be trading right at 50. It is a neutral position. Let's change the structure. Let's sell a March 50 call and buy the June 50 using in-the-money options for a horizontal spread and see how that changes our dynamic. So let's sell the 50. We'll put that at 240 based on midpoint. And we use 420 for the June. Okay. So I'm going to sell the 50. Oh, I'm sorry. No, we just did. We just did the 50s. I apologize. I was thinking ahead to the diagonals. Let's go ahead and just take a number. Let's take the 47. Now I got to take the 45. We want to use the 45. Sorry, folks. Okay. So let's say we went in the money and we sold a 45 call for about 585. And now at the same time, we're going to buy the 45 call for June. We're going to call that $7. So going in the money in this fashion, we get a lower debit of 115. But the stock's at 50. So if you had a bearish sentiment on DKS, you could enter the horizontal. But remember now, this max profit, almost double of what we'd see on the at the money, only exists if the stock falls to $45 per share. And remember, this profit is based on what the theoretical value of the long call would be at short-term expiration. That can change. Remember what I talked about implied volatility crush. If the implied volatility goes to 0.20 for both options, my return is going to be much less. You can simulate that here using the tool. So let's set our implied volatility at 0.20. If there is a volatility crush and the stock was trading at $45, that means that our June option is not going to be inflated as we want. We may only see a profit of $17 instead of the 205. This is the trick that gets people, not only with horizontals, but with diagonals. The return you're seeing is based on a theoretical value. And if you're playing an implied volatility crush around an event, you have to take into account what would the crush be on your long option as well. We don't know. You kind of have to guess that, looking at some of the values such as the implied volatility range of the option, where it has been. If an event passes, what would it likely decay to, near to its average perhaps? And this is probably extreme. It might only go to about 0.3 or 0.35. You'd still get a profit, but remember, the return is based on the theoretical value of what your long option would be at short-term expiration. Doesn't change the fact that a horizontal by definition at the money is still neutral, and if you go in the money, you've got a bearish sentiment. You need the stock to fall to get closer to that maximum profit. The upper and lower break-evens are about the same, a little bit wider. It's 13 points now instead of 10 because the higher premium you received. Now if we go out of the money, if we go to the 55 calls with a horizontal, that's going to give us a speculative bullish sentiment. So I might get 60 cents by selling the March 50, go to June again, I'm sorry, the 55, and we'd pay 220, 215 to 220, somewhere in that, or probably 220. Okay, so we'll call it 60 cents and 220. Now naturally we're going to have a lower debit. We're going to get a debit of around, pretty close to 160 here in this case, so it's about the same. Profit is still about the same as the at the money, but remember, it's based on the stock moving up. You've now created a bullish sentiment rather than a neutral. Why am I going through all of this? Well, it's because you can structure the trade different ways. Make sure you graph the trade and take a look at the profit and loss chart, because if I have a neutral sentiment on DKS, doing this out of the money horizontal makes no sense. Why would I put myself in a position where my break even is only 86 cents away from where the stock is right now if I'm neutral? Although this is a neutral structure, it's got a bullish slant from where you are in the position. So the structure has to match your trading plan, and it has to match your goals for the position. Could I structure any of these trades using different expirations? Absolutely. Well, I could sell the March 50 we were talking about originally for 240, and I could buy a leap. 50 call for, let's call it 665. How is that going to change the structure of the trade? Well, I'm going to have a higher net debit, aren't I? And of course, in this case, with the higher net debit means I'm going to have a lower return. You would have extended, not your insurance, but you would have extended the ownership here. We now have almost 300 days out in time. But the debit goes up to 425. And then you'd say, okay, well, maybe I'm neutral in the first month and I expect it to go further and further, in which case you're planning to sell continuously against the position. There's nothing wrong with that. But as I said before, in general, most investors who I talk to are looking to do a one-cycle trade, just that one out to the 15 or maybe 10 or maybe 20 days out in time, short option, buying an option that's 2, 3, 4 months out in time because they want that return in the first month and they're not planning on managing it longer term. If you're bullish on a stock and you think it's going to have a good continuous move upwards, maybe a few hiccups here and there along the line just with the market pullbacks, there's nothing wrong with buying a leap option, but you're most likely doing a diagonal spread to right against it continuously as opposed to doing the horizontal. Okay? All right. So let's go back now. We talked about the strike selection. We showed how it differs if you go in the money or out of the money with your horizontal. And the expiration selection, I chose the March to June spread because I typically want at least 3 right cycles between the option. What is a right cycle? Well, the right cycle is defined as the days remaining to expiration on your long option, the option that you bought, divided by the days remaining on the short option. It tells you how many times you could theoretically sell premium against the option that you purchased. So it's an important term that's used in calendar spreads that's not used in other strategies. As a vertical spread, we just write the same cycle. We have the same right cycle, okay? Dynamic collars, maybe we could look at that way too. But in general, I want at least 3 right cycles. And it's because if the trade doesn't work out the way I wanted it to in the first one, I don't want to enter a whole new trade. I just might want to roll or adjust the short option. If I haven't met my goals or the stock didn't meet my expectations in that first week, the first 20 days, or in our case, the first 17 days. It gives me an option, lack of a better term, to go ahead and now sell the April while keeping my June in place. If I hit March expiration, I'm not near where I want to be. Or if I desperately need to manage the position because it did the exact opposite of what I expected. I bring this up because the Power Options tools will allow you to search for horizontal or diagonal spreads where you're selling this current week, 3 days out to Friday, and buying next week, where you can go 1-to-1, or buying 2 weeks out in time and selling the near term. But I don't like that. If I'm using straight weeklies and I'm selling this week with 3 days out, I'm likely buying the 3-week out trade. Maybe the March 17th, but more likely the March 24th or further, because I want 3 right cycles. And if I've decided, in the case of DKS, which does not offer weekly series, well, if I sell the March, I'm likely going out to June, so they have at least 3 cycles. Now, the right cycle combination, March is 16 days to expiration, the June has 107 days. So technically, by definition, that's 6 right cycles. But because weeklies aren't available, I can't write an option every 16 days. When I hit March expiration, April's going to be 28 to 30 days out. Now when I hit April expiration, May is going to be 28 to 30 days out. I'm not going to have the ability to write it 16 times. Okay? But I know that I have 3 cycles available if necessary, that I can write the April, and then I can later write the May, and I could potentially write the June as well after the March, technically 4 right cycles. But if I sell the June against the June, that would just create a vertical. But it's one way to typically continue to manage a spread if you haven't met your goals or you're trying to repair a loss. You take it out that far, you may consider rolling your long option further out, but remember, that's because the position didn't go in our direction. If DKS, in our example, in the next 17 days stays around 50, which is unlikely because it has earnings coming out on the 7th of March, but if it stays at 50, I probably would just close that horizontal spread, take the profit, and then look for a new position that I'm neutral on, rather than continue to write and manage it, because that's not the goal of the horizontal. We already showed this. Could you use further out options instead of what I showed with just going a few months out, maybe 3 to 4 months out, and then selling the 17-day out or 1 month out? Absolutely. But remember, it changes the debit. It lowers the return based on your expectations. The strategy and the structure of your profit and loss has to meet your goals. Horizontals are neutral. The profit relies on implied volatility crush and rapid time decay of the short option and a slower time decay on the farther option. Because of these 3 ideas, I consider the horizontal to be more advanced. I consider it to be an advanced strategy. Let's consider briefly the profit and loss chart of this one more time. We'll go back to our example there for DKS. Okay? It's a neutral position. Yes, you have a wide 10-point range to break even. But my target in this strategy is I'm entering it because I liked this. I was very interested in this peak or near the peak. So it's neutral. I'm claiming that in the next 17 days, I feel the stock's going to be trading right at or near 50. I consider this advanced because, to be honest with everyone here online, if you can pick stocks on a consistent basis that over a 10-day, 15-day, or even 20-day time period might fluctuate but are going to end up trading right at or just within plus or minus 0.5% of a particular strike price, you probably don't need my help. You're probably much more profitable long-term than I am if you can do that on a consistent basis, and by consistent, I mean above 80% of the time. And it's also because you need to have the background of options. As far as what would you look at for a standard implied volatility, the option you're looking at trading, what is its average implied volatility, what is its range, and if it looks inflated now, do you have a sentiment that it will collapse? The implied volatility will collapse and the time value will decay much more rapidly in the first 15 days as opposed to what might happen to that option that's further out in time as well. That's why I consider it advanced. Okay? Now, some of you might not like the way that I started this out. That's okay. You might have wanted me to start off with the diagonals, which I'm going to get into now, which is the more common form of a calendar spread. But it was important to break apart the definitions. We need to know there's a difference between the horizontal and diagonal. Why do I not use horizontal spreads? Jerry asked this question earlier. What is my favorite one? Why do I not use horizontal spreads that often, if ever? And again, it's because I'm not that adept at saying that 10 days from now this stock's going to be trading right at that price. Yeah, I can believe a position is neutral and it's going to be trading within a range. That's usually when I might do an iron condor or double diagonal, which we might discuss later. But the horizontal there, although it offers that high profit, the leverage position, and it is an implied volatility play, you can get the implied volatility crush you want, see the rapid time decay on the short option, and still lose money because it is a neutral position. Now, before we jump in, and Jerry says, yeah, you have to watch it closely. You do have to pay more attention to it because remember, in our example with DKS, Jerry, we had sold the 50 call. If the stock is even trading at 50.25 or 50.30 or 50.50, it moves slightly in the money, remember the obligation. I can be assigned at any time. And what happens if I'm assigned on that calendar spread? Well, I don't own the stock. So if I get assigned early, before earnings, which I wouldn't, again, trade, but before the earnings or before expiration, my broker is going to look at my account and say, oh, he doesn't own stock, but he owns the right to buy shares of stock at 50. So let's exercise his June. He'll buy stock at 50, sell it at 50. Even though the stock's in that profitable range, where am I? I'm at a loss. I paid $1.80 debit to get into the position, and I didn't get any profit value back. You have to. And Jerry, thank you for bringing this up. It's something I was going to get into later, more in the diagonals, but this is something that's very important with the horizontals. Remember, when you're in the money, you can be assigned any time. And if you're assigned early and your broker automatically exercises that call, you don't get any profit back. You bought stock at 50, you sold it at 50, and you paid a $1.80 debit. You're out. The profit on the horizontal is made not only from the crush of implied volatility, and of course the rapid time decay of the short option and being a neutral position, it's also based on being able to sell to close the long call at any time, not being exercised because you were assigned early. That is the worst thing that can happen to you, in my opinion, other than stock tanking to zero or going up. And even sometimes, yes, Jerry, if you're in an ex-dividend and your option is right at the money or slightly in the money, you're going to look to manage it because you can't risk getting assigned early because you get nothing back. All right? Which brings us to the benefit of a diagonal calendar spread, the most common, and the one that I commonly use in my account. Now, although I like to use this strategy, there are gurus, there are services out there. I think there's even a book out there, and maybe even a seminar series called The Poor Man's Covered Call. A diagonal spread, sometimes called the poor man's covered call. Frankly, I loathe that term with a passion. Okay, here's the reason why. First off, most of us who are trading options investing are probably not poor to begin with, but I get the cute, catchy term. But in this structure, we're going to buy an in-the-money call. We'll stay with the calendar calls for now. We're going to buy an in-the-money call that's farther out in time. It could be a leap. It could be that June series that's 3 or 4 months out. It could be 8 months out in time. But we're going to buy an in-the-money option, and it could be deep in the money with a delta of close to 1. This is where they get the idea. If we go deep enough in the money to get that delta near to 1, we're mimicking a 1-to-1 movement with the stock. Okay? And then you're going to sell the near-term call, just as you would if you own the stock and we're trying to do a covered call. You're going to sell an at or out of the money call, depending on your outlook for the stock and your goals for the position. So now we're still using the same structure of buying an option further out and selling one near term, but we're going in the money with the farther out option to give us a better delta ratio. Now, that being said, by itself sort of dictates why I don't consider this a poor man's covered call, and I don't like using that term to define it. Okay? So number one, we don't own the stock. We own the right to buy stock at a lower price. That is true. But in the dynamic of a diagonal spread, we have two options that are moving and adjusting differently as the stock moves up and down over the time frame. We don't own the stock. We can say, oh, the stock's up 37 cents, so I've gained 37 cents on that asset that I bought. The stock's down $2, so I've lost $2 on the position. Again, a calendar spread, a diagonal spread, is still leveraged, which means we fall into the lie of leverage. If we see a 10% drop in the stock, that could result in losing 40, maybe even 50% in value of the long option. That's what our investment is. Okay? If the stock drops 5%, I may even see a 20% decline in buy long option. Okay? So the structure might look like a skewed covered call position, but we're talking about having two options that are moving dynamically, and you have to pay attention to both. Yes, we want the stock to move up in general. Diagonal call spread is a bullish strategy, just like a covered call. Neutral to bullish, just like a covered call. But we have to watch both when we're in the trade. Okay? And again, just as we talked about with the horizontal, the profit that you see in a profit and loss chart for a calendar spread is based on the theoretical value of the long call at the short-term expiration, not on assignment. Okay, not getting assigned the short call and using the long option to deliver it. And that's an important factor. What are the goals with a diagonal spread? Well, it gives us a little bit more dynamic. It's a neutral to bullish strategy. We typically would not have two break-evens as we saw in the horizontal, which is beneficial because if the stock gaps up, because we were bullish, we'll still have a gain. Might not be the maximum gain, but we don't enter into that loss if it's structured properly. It does mimic stock ownership. Okay? Now, I have to agree with that. It does mimic stock ownership while still taking advantage of being able to sell near-term premium. The strike setup and the expiration. Okay, again, do I choose to sell an at-the-money or an out-of-the-money call? Do I buy 2 strikes in the money, 3 strikes in the money, 4 strikes out of the money? Do I buy a leap? Do I buy a short-term 3-month out call? That is all going to depend on your outlook for the stock, the goals for your position, and the goals for your portfolio. Unfortunately, there's no one answer of what is the best calendar spread. We're going to talk about that a little bit more next week. But in general, I'll just take the names that came in. If Indra has more of a shorter term bullish to neutral position and Jerry is bullish longer term over 6 to 8 month period, they'll both maybe trade diagonal spreads, but they're going to be structured very differently based on their outlook for the stock and their goals for the position. Remember, going farther out in time results in a higher debit and a lower profit on the first right cycle. That's one of the other differences of a diagonal as well. Most investors who use a diagonal are planning on managing or selling the short-term premium month by month or week by week over an extended period of time. Whereas again, most investors I talk to who do the horizontal are looking for that one cycle trade, and they'll exit the trade if they've gotten the profit in that first 7 days or 10 days or 15 days and not worry about continually rolling and lowering the cost basis of their leap. Okay, but what does our structure look like? Let's stay with DKS for now. Looking out in the near term, I might sell a March 52.5 call at 130, and at the same time, I'd now buy a June 45 call at 710. Now this gives me that higher net debit of 580. But I have a difference in strike prices of $7.50. Okay, so we're buying a 45, I'm selling a 52.50, and that's going to be important. Okay, one of the other important factors here, which don't relate to covered calls necessarily. Yeah, many of you covered call traders might pay attention to the delta of your short option based on what kind of structure that you want, and as a management tool as well. But in the calendar spread, in a diagonal, what we typically look for is a minimum delta ratio of at least 1.6. What does that mean? It's the delta of the long option divided by the delta of the short option. Why is that relevant? Because when the stock moves up, remember I'm neutral to bullish, and here we went 2.5 points out of the money, got a reasonable premium of $1.30, but now in this case, if the stock moves up, I want to make sure that I'm gaining more on my long option than I'm losing on my short option. And a good ratio of 1.5 or 1.6 is a good starting point. I typically use 1.6. This example, delta is 0.73 for the June 45 in the money call, and our out-of-the-money March 5250 is at 0.33, so we have a delta ratio of 2.12. Similarly, you still might want to look for an implied volatility ratio that's above 1, okay? Because you do want maybe a higher implied volatility on the short option than the volatility of the option you're buying. I'll talk about that a little bit more in just a moment, but that's just a general rule. Maybe greater than 1 here, and I want a delta ratio of greater than 1.6 with my diagonals. Here's the profit and loss for our DKS diagonal spread. Buying the June 45 call and selling the March 52.5. Again, the max profit for a diagonal spread is pretty much always realized if the stock is trading right at your short option strike price. But we have to keep in mind, again, what have I done here? I've entered into an obligation to potentially deliver shares of stock I don't own at 52.50. But now I have the right to buy those shares of stock at 45. This is where that difference in strike prices is relevant. Okay? Notice here, if the stock continues up above 52.5, let's say at March expiration, I fall off of the max profit, but I'm not entering into a loss again. That's because we properly structured the trade. When you set up a calendar, especially if you're using the idea of mimicking a covered call, the poor man's covered call, what you have to make sure is that the net debit you paid to get into the position, in our case it was 580 for this spread. Okay, it's 580. Sorry, that looks more like a delta view there for calculus, is less than the difference in strike prices. Okay, why is that? Well, it's because if the stock suddenly gaps up, which again we might see because of earnings, and suddenly goes up to 62, again, I may be assigned early. So I'm going to be forced to deliver shares of stock I don't own at 52.5. But I own the right to buy them at 45. So my broker would exercise this, buy shares of stock for me at 45, deliver them at 52.5, and I get $7.50 back. So I still make a profit in this case, even if I'm assigned early. And it trails off after that. Why? Well, it's because the delta here is going to 1. And this one hasn't reached 1 yet, just as we saw before, but it doesn't go back into a loss. We have a much wider range of profitability to the upside, in fact, infinite to the upside. This here, by the way, why is the profit here, or even just above that, not this difference of $1.70, right? My profit here, if I got assigned early, got $7.50 back, would be $1.70. Why am I seeing a profit at roughly about $3.10, $3.20, somewhere in that range? Because again, that's based on if the stock's trading right at 52.5, and I don't have to pay anything to buy it back, because as soon as it goes above that at expiration, it enters a delta of 1. But the max profit is realized if the short call expires right at the money, and we could sell to close this not for $7.50, but for probably $8.70, maybe a little higher, because that would be the theoretical value, because it still has 3 months of time premium remaining, plus the $7.50 of intrinsic value. But as the stock moves up, we start to lose because we have to pay 1-to-1 to buy back the short call. So although in this case I properly structured it so that the net debit that I paid was less than the difference in strike prices, and that's a setting we can put it on PowerOptions to make sure we're only seeing spreads that have that, this means that I won't have a double break even. And this means even in the case of early assignment, because an unexpected event happens, I'm still making a profit. If I entered this spread with a debit of $7.80 for whatever reason, okay, what I'd see here is more of a profit and loss chart of what we had with the horizontal. We'd go up, we'd peak, and we'd start to come down, and then we'd level off here. So it's not as extreme as a loss to the upside as the horizontal spread would be, but what you're looking at here is that if you get assigned early because the stock suddenly gaps up and you paid a debit of $7.80, you're assigned early, Your broker exercises the long, you get $7.50 back, you're locked into a loss of 30 cents. This is key. In either scenario, whether you're doing a diagonal or a horizontal, you want to avoid early assignment if possible. In the case of that sudden gap up, if DKS jumps up to $62 and I get assigned early, I can't avoid that, which is why I'd always make sure that the net debit is less than the difference in strike prices, so I'd still realize a profit, though it might not be near that maximum profit. Going back to Jerry's question, why do I avoid horizontals? Because if the stock does gap up and I'm assigned early, I'm going to take a loss. And I don't have the control to manage it any further. Okay? You know what I mean? If I'm assigned on this long call, I can buy another call, but I can't roll this now. It's gone. It was exercised on me. All right. So let's clear this up here. Let's talk about it. Is this a poor man's covered call? Well, we are mimicking stock ownership with an in-the-money call. That's true. We can set the delta closer to 1 if we want. We take advantage of selling the same premium at the money or out of the money that we would in a covered call position if we're slightly bullish. But we've already explained why it's not just a poor man's covered call, that why I can't look at the position and say, hey, if it moves up and I get assigned on the short call, I'm at or near my maximum profit, so I'm okay. The last thing we typically want to have happen is to be exercised or to have our broker have to exercise our long call because we were assigned early. If we do that, we lose the time value profit that still remains in the leap. And that's what that structure, that's why we got in the trade, because we like that maximum profit. Okay, let's take a look at some of the structures there. You know, we'll come back to this here, but let's go back to the structures and power options, just to look briefly at what is the difference between in the monies, going further out in time, and more. All right, so let's go back here. All right, now we're going to take our diagonal, and we did the March to June. Okay, so I sold the 52.50. It's now at about 145, so we'll put that in. Now, what's the benefit of going deeper in or deeper out of the money? Well, if you go deeper in the money, you get a delta closer to 1 and a higher delta ratio. But you're going to pay more for it, so the overall return might be slightly less. Let's take the June 50. Okay, so we only have a 2.5 point strike difference. We're going to sell this again at 430. We're going to buy this, I'm sorry, at 430. I want to show this example. So here we're doing the same, it's a diagonal. We're just not going as deep in the money. We're just going the 50 call. And I wanted to show this because look at here. In this scenario, my net debit is 285. We sold the March 52.50 for 145, bought the June 50 for 430. I got a debit of 285. This, many of you are thinking that you always see a diagonal that has that structure where it tails off, but then the profit just comes off a little bit. Here we may actually have 2 break-evens. If the stock goes above 65, I might be paying intrinsic value just for this, and this might be going to intrinsic value, my 50 call as well. The stock continues to move up or close to intrinsic, but in that case, if I close both legs, I'm only getting 250 back, and we paid 285. So that's why this profit and loss rate, it is a diagonal. I bought an option that's further in the money, but remember, if my net debit is more than the difference in strike prices, if I get assigned early, I'm locking into a loss of 35 cents. This is very important because even though the profit and loss chart shows you could have a profit at March expiration at 55, 57.5, or 60, not the max profit, if you get assigned early, this return was based on the theoretical value of the long option at short-term expiration. If I get assigned early and I'm forced to deliver shares at 52.5, my broker gets them for me at 50, I only get 250 back. I'm at a loss of 35 cents, even if the profit and loss chart still showed I was in a profitable range. Okay, that's why we typically want to go at or out of the money. You know, the idea of a long-term sort of covered call trader who's maybe selling calls against his position to create a dividend-like income on a monthly basis, but he wants to hold the stock long-term, that investor is selling the calls at typically above, half a strike or 1 strike above the current stock price because they don't want to be assigned. That should be your approach as well. If you're doing a diagonal spread, and you're using leaps, and your goal is to sell it month by month or week by week against a 4-month out or 5-month out option, you have to be a little bit out of the money. If you're selling right at the money, you're taking a 50-50 shot, you may be risking early assignment, where even if it's structured properly, you might realize a return, but the max return you're expecting, or these returns in this range, you won't see if you're assigned early. Okay, so that's sort of the key. Now, a leap, what's wrong with using a leap? Nothing. Nothing's wrong with using leap. Let's keep our same out of the money March 52.5 call, and let's go to January, 324 days out, and let's do the 45, which is now probably going to cost us about $965 or $970. We'll call it $965. Okay, so higher debit, which means in the first right cycle, because we only collected $1.45 against it, we still have a debit of $8.20. In the first right cycle, when you go further out in time, you may see this upper and lower break even. Of course, I would have only done this position if my sentiment was the stock would be trading around 52.5. Does this mean it's a bad diagonal trade because it does have an upper and lower break even? Not really. Is it a bad trade because now the net debit that we have to pay is greater than the difference in strike prices? In my opinion, yes. I keep that same rule. Even if I'm buying a 2018 leap or a 2019 leap, I want to make sure that the net debit that I'm paying is less than the difference in strike prices. But your goal here with buying the leap is you're planning on keeping most of this 145 at March expiration. And then you're planning on selling the April. And your goal is you're going to continue to knock down this premium month by month because you wanted to be in this trade and you had a neutral to bullish outlook, relatively strong outlook for your stock over the next 3 to 4 months, and you're likely planning on being in the trade for 3 to 4 months as well. This would be a reasonable return in the first month if the stock ended up trading up right at 50 on March 17th. It's a 33% yield. I'm not denying that. But if my sentiment was that the stock was going to be trading, Dick's Sporting Goods was going to be trading right at 52.5 or somewhere around there in the next 17 days, and I wanted to see a reasonable return, but I'm not planning on continuing in this trade month by month by month, that's when I'm probably looking at June, going at least maybe 90 to 120 days at a time, 3 or 4 months to begin with. That gives me the structure I want. With that, we'll keep the in the money call here at 740 or whatever we had earlier. Whoops, sorry. So this gives me an opportunity to do what? Well, this gives me an opportunity to realize a reasonable return. Our debit was a little bit low. I think I might have had that at 725, I'm sorry. But anyways, with a 580 debit. So here I'm at a 49% return if it works out, or around that, if it works out as I want. And if the stock gaps up, I'm still at a profit. And if the stock gaps down, I'm not risking 820. Okay, I'm risking a lower net debit. So if you're just looking for a 1 or 2 month trade, I recommend only going 3, 4, 5 months out in time. If you're longer term bullish and you do want to mimic just selling premiums on a month by month basis on a stock that you're neutral on, that would be the advantage of using a leap for your calendar spread. Okay? There are other advantages and disadvantages as well, but again, just have to reiterate, it comes down to your expectation of the stock and your goals for the position. As always, just with the horizontal spread, I'm usually going to look for a position that gives me at least 3 right cycles, minimum. I usually like more than that, but I want a minimum of maybe 3 right cycles against it. But as we saw, I could use DKS as a 1-cycle trade with a diagonal and still realize about maybe a 40%, 45% return. The stock's trading right at the strike price. It is always best to have a net debit less than the difference in strike prices. You still may want an implied volatility ratio of greater than 1, where the implied volatility of your short option is greater than the implied volatility of your long option. And most of the time you'll be able to find that. The times when that's reversed, why would an option have an implied volatility that's higher out to June than 1 in March? When you see that, it's typically because the underlying security has an event coming out sometime in April between the two. That could be a pending patent lawsuit judgment, a court case of any kind. For a pharmaceutical, naturally you'd see it if the phase 2 or phase 3 drug trial results are expected in April. Well, the March options might still be inflated, but the May and June would be higher inflated, would have a higher implied volatility because they're going to be the most affected by that announcement. Okay? But that being said, does it have to be much greater than 1? Not necessarily. Think again about the structure of the trade. If I found a stock, let me go back one more. Let's switch screens again. Sorry, I usually don't like to bounce back and forth, but let me switch again. Think about the structure of this diagonal trade. If I like DKS, and throwing it out the window saying that earnings weren't coming up on March 7th, but if I liked the monetary cost of this position, if I liked the maximum profit, and I thought that DKS was going to stay within this price range based on my analysis, technical research, and so forth, if the implied volatility is a ratio of less than 1, you know what? I'm okay with that. Why? Well, because if the stock stays where I want it to, I'm still going to realize a reasonable profit. If the rest of the market thinks the short-term option is undervalued and the long-term option is slightly overvalued, that might be okay, as long as the stock stays within the range and I like the position. But in general, I'd have to be careful. What I mean by that is if I see my far out option, 3-month out, 4-month out, has a high IV ratio itself, meaning that it looks like it's overvalued, I need to find out why. Because remember, I don't want my long option to suffer an implied volatility crush more than my short option. I want the reverse to happen, even in the diagonal. Yes, that's the mainstay of the horizontal, but in the diagonal, yeah, I still want to see more rapid time decay and hopefully more of an implied volatility fall on my short near-term option than on my long. Okay, but again, to me, most important with these diagonals is that the debit is less than the difference in strike prices. In addition to that, I still want that delta ratio greater than 1.6 typically. And again, I don't have an answer for you of which one's best. Okay, what is it best to go 3 strikes in the money? Is it best to look for a delta of 0.8 or more and keep the short option delta at 0.3 or less? That depends on what the stock does. That depends on your expectation of the stock itself, okay, and your plan for the position. Speaking of a plan, Jerry just asked a perfect question. What we're looking at, of course, is calendars today. But, you know, what is a calendar spread but a bull call debit spread used at different strike prices? Okay, what do I mean by that? Well, one more time, Jerry, let's go back. The structure here of buying an in-the-money call and selling an at or out of the money call is a bull call debit spread. I've just changed the expirations. So what is the advantage of doing the calendar as opposed to just a vertical? Well, the calendar would keep more time premium on the option, whereas if I reach expiration, if I bought the 45 March and sold the 52.5, I'd have a lower debit, absolutely. I might have a higher percent return, absolutely. But at the same time, the return is based on the time value that remains on the long option. What's the advantage of this? Well, if it goes against me, I have in the first 17 days or right at March expiration, the stock's between the strike prices. I'm not near my maximum return or it's nearing my break even. It's much easier to just sell an April call, maybe at the 50 strike, against the June call I already own without having to pay that again or roll, oh, I'm sorry, folks, or just roll one call. Whereas in the debit spread, I'd have to take the loss because I have no time left, and then I'd have to roll it. So you're right, Jerry, a vertical spread would probably, let's just look at it. I'm going to clear it out. Let's look at a vertical spread. If I just thought the stock was going to be anywhere above 52.5, and by the way, if I did a vertical spread, I'd go in the money, whereas a calendar, I'm going at or out. But if I did the vertical spread, I did the bull call debit spread, what do we know? We're going to have a lower net debit. We're going to have a slightly higher potential profit. I definitely need the stock to move up. I'm already right at break even at this point. You know, we're pretty close to break even here, even closer than we were in the calendar spread. But yeah, I need the stock to move up to make the maximum profit. It is more of a bullish approach, and I have 17 days. 17 days to make a profit, 17 days to manage it. And then if it's going against me, sure, I can roll out to April the whole spread because I'm losing on the whole spread. But the other idea is that in the first 17 days, remember, the option I bought further out in time is not decaying as rapidly. So I feel it's easier management because I have a longer term option. By the way, most of the times if I do a bull call debit spread, I'm doing it a different way. I'm probably selling the 47.5 and buying the 45, so I'm deeper in the money and I have a better probability of success. The at the money calendar spread diagonal usually is done because maybe I plan on trading it more than once. Maybe I didn't, I've said that, but maybe I didn't make it clear. If I'm using a diagonal spread, I am planning on writing it usually 2 or 3 times, rather than just managing a bull call debit spread month by month by month. Okay, I'm going to keep that long option there and keep whittling down its cost basis until maybe I get in the last 60 days, so the time value of that option really starts falling off, my long option. So this is, a diagonal is more of a plan of being in a position and continually writing against it because you have a longer term growth expectation or neutral to bullish expectation on the position. Whereas a vertical spread is typically a one and done. And as I mentioned, a calendar can be a one cycle trade if you've met your goals. But I feel it's easier to manage because I haven't lost much on the long option. And remember, even if the stock goes down to 45 at expiration, the 45 call for our bull call debit spread would expire worthless and be gone. We'd have to roll to a whole nother spread where my 45 call out to June would still have some time value, and I could maybe make that a horizontal by selling the April 45 call against it. Okay. Now, real quick, there is another diagonal. Some call it the reverse diagonal. They'll reverse the initial setup for a lower net debit. It's still considered a diagonal, but in this case, we'll still sell the March 52.50, but rather than buying an in the money, we'll buy the June 57.5 at $1.45. Okay, so my strike that I'm buying is higher. This gives me a debit of 15 cents. What's the advantage of doing this? Well, it's a lower net debit. It's still a neutral position, but now it's neutral to bearish. The wider profitability range is to the downside. Okay, so here I sold the 52.50 and I bought the deep in the money 57.5. I can take a larger loss if the stock gaps up. So the reverse diagonal of selling at the money and buying further out in time but buying it out of the money gives me a lower net debit, a higher percentage maximum profit, but that doesn't equate into a higher monetary profit. But yes, the percentage based on the 15-cent debit I had, I could make, right here about $170, $180. So the return looks fantastic. But it is neutral to bearish. And again, profit is only realized here. Now, investors who typically do this structure will do this to do it in a form of double diagonal, meaning at the same time, they might sell a 47.5 put for March and buy a June 42.5. So then you'd see their calendar put. They've made a bullish put spread. Yeah, they've done a bullish put spread. When typically when we think of a calendar put, it's a neutral to bearish strategy. But by reversing the structure and buying an out of the money and selling an at the money, you get a lower net debit, but you reverse the direction. A reverse diagonal call is now bearish to neutral. A reverse diagonal put spread is now neutral to bullish. Okay, so the question is here, although we like the lower net debit, that's the main advantage of this structure. When you reverse it, when you buy an out of the money far term and you sell an at the money near term, you get a lower net debit. Okay, you can get a higher percentage return, although it's lower monetarily. But if I was considering this reverse diagonal, I might want to compare it to the standard diagonal of a bull put. They're almost parity trades. What if I had sold the 52.5 put and bought the 57.5? That would give me almost the same risk-reward profile, but a higher debit. But then in that case, I also have to ask myself, would I ever sell the in-the-money 52.5 put? No, because I don't want to risk early assignment on the position. But standard calendar put would sort of equate to this parity trade, to the reverse diagonal. Okay. Do I find this useful? Well, it can be, because again, you've got a lower net debit. You're adding more leverage. But remember, you're changing the direction of your strategy. Here I'm using calls to create a bearish strategy instead of what we might consider calendar calls bullish as well. Bill asks a strategy question, or I'm sorry, criteria question. Does PowerOptions calculate probability of touch? No, we show the theoretical probability the stock will be trading at or above or at or below a strike price at expiration, not the theoretical probability that would ever touch the strike price anytime in the next 17 days as well. Okay, so a quick review of the diagonals. It is neutral to bullish strategy when you're doing calendar calls, neutral to bearish if you're doing calendar puts. But again, you could do the reversal and you can make a neutral to bearish with the calendar calls set up differently and so on, okay? The main idea of the calendar calls is to mimic stock ownership, the quote-unquote poor man's covered call, but remember it falls into the lie of leverage. A 5% decrease in your underlying stock could be a 15 to 20% loss on your long option. Remember, that's what you're invested in, not the stock. The concepts are similar to a covered call, but you have to pay attention to the two dynamics of the two options. Those things such as the delta ratio is important. The debit to strike difference ratio is important. And the IV ratio is even important as well, which you don't look at with a covered call. We have to remember we're doing two derivatives now that are moving dynamically with the stock, so it's not a simple discussion as a poor man's covered call. And also remember what we showed with those profit and loss charts. The max return that you're looking for, one of the reasons why you probably selected the trade is because it's based on the theoretical value of the long option if you're able to sell to close that option and not be assigned early. Okay? If you're assigned early and your broker exercises your long to deliver the short early, you're not going to get that maximum profit. You still might be a profit if set up correctly where the debit to difference in strike ratio is less than 1. Okay? That'll still give you a profit even if you're assigned early, but that's why it's important to do that. I don't want to enter a calendar spread if my goal is short term or if my goal is long term. I don't want to do that where the debit is greater than the difference in the strike prices. And of course the right cycles I mentioned, I'm typically looking for right cycles of at least greater than 3. But again, if you're longer term, if you want to mimic a great idea is if you don't, I don't have the money to buy 100 shares of Alphabet or Google right now in my account with my other positions that are open. Actually, I don't, period. I'll be honest with you. But Priceline, Google, those might be great plays for a calendar spread position because I can mimic the stock ownership. Okay, but at the same time, I want to make sure I have at least 3 right cycles in case the first month doesn't go as planned or it goes against me and I'm forced to manage it as well. Now real quick, I don't want to get too deep into this, but we talked about a reverse diagonal where I'm still selling near term, I'm buying farther term, but I'm buying a higher strike on the calendar spread, which gives me a bearish sentiment. Some of you I've talked to, I see online right now, like to trade what are called reversals. I'm not a fan of this trade. I'm going to share it real quickly. I'll talk about what I think are the pros and cons, but I don't typically do this. A reversal, still a calendar spread. You can do it as a horizontal or a diagonal. A reversal is where I sell the far-term option. That's 3, 4, 5 months out in time, and I buy the near-term option that's 1 or 2 months out in time. So I get a credit. The background of this is it goes against the core principle of options trading. One of the core principles. What is one of the core principles? When you're selling premium, you want to sell week by week or month by month to get a better annualized return. The options at 6 months out in time is not 6 times the cost. So when I'm buying, I want to buy further out in time. Yes, I'm paying more up front, but it's not linear. I'm not paying 6 times the cost if I buy a 6 months out option. So when I'm selling, I get a better annualized return going month by month by month or week by week by week. And when I'm buying, I get a better annualized cost against myself buying 4 months, 5 months, 6 months out in time or a year out in time instead of buying month by month by month. This also changes the entire dynamic of the position. Okay, the goals of the reversal are you get a credit rather than paying a debit. You're expecting a large move in the short term, sort of mimicking a long straddle or a long strangle, which is weird because you've sold an option further out in time, but you're getting a skewed profit and loss chart that's similar to a long straddle or a long strangle. It requires more management and more watching. So here's an example. We'll keep it at a horizontal. Sell the June 52.5 call. The June, the one that's 107 days out, I'm selling it now for $3 premium. I'm going to buy the March 52.50 at 130. So I have 17 days of owning a long call that can help cover the short call. And I get a net credit of $1.70. The max profit is infinite. We've flipped the entire horizontal spread. That's why it's called a reversal. We flipped the position, the profit and loss chart. Instead of making the max profit when the stock's at 52.5, we lose the most if the stock's at 52.5. And if the stock doesn't move what we want in the first 17 days or in that first right cycle, now what do I have to do? In order to stay in the trade, I have to buy another 52.5 call for April. What am I doing? I'm increasing my annualized cost. But earnings are coming up, so if the stock swings below 47.50, I'll have a profit. How does that work? Well, my March call expires worthless, and my 52.50 June call is losing money, so I'm getting more of that $1.30 maximum profit. What happens if the stock gaps up? Well, we took in $1.30. I can buy shares of stock at 52.50, exercise my March call to deliver the obligation at June, or close them both. But I kept the $1.30 net credit. So the reversal might be an earnings play because you get a credit up front instead of paying debit for a long straddle or a long strangle. It can be profitable, but you need a movement just like you would in a long straddle or a long strangle. And if things don't work out the way in the first month, remember you're going against the general core principle, one of the general core principles of options investing, because you'd have to buy another 52.5 and you're increasing your annualized cost. Okay? My take on reversals, to be honest, I haven't studied them that much. It's great to get a credit, but it has to be managed, and you need a large movement in one direction or the other to realize a profit in that first cycle. You know, if I bought an April call instead of the March, I'd have a lower net credit, but I'd have till April, the stock to move one direction or the other. The concept of the trade, the actions of the entry is I'm lowering my annualized premium and I'm potentially increasing my annualized costs because I may have to buy another call or another put month by month to cover that short obligation. If I leave it alone, let the March expire, now I'm holding a naked call, which is not what I want to do, out to June, okay? And it might be good around earnings. You got that V profit and loss chart. You want to swing one direction or the other, and you already accepted the credit. But again, it's still going to have to be managed at the end to realize the profit. You're going to have to close out those two options, okay? Ash says, how is a reversal margined as you are short the longer call? That depends on your broker. I do have a gentleman I talk to that does reversals. He actually, as long as he has that near-term option open, he has the right to buy shares of stock there beforehand. They don't charge him margin on that. He gets in that credit if he has that shorter one in play. However, that being said, if I had to leg into the position at my account, let's say my Fidelity account, for example, an IRA account, if I legged into it, even if I bought the long call first and then tried to sell the short call, they wouldn't let me because that one's not qualified to do naked calls, and that's how they would count it. And their calendar entry doesn't allow you to sell the farther term and buy the nearer term, okay? So you'd want to check with your broker. There may be additional margin requirement in that position. So that's what you have to watch out for, okay, in that setup, okay? So I know I went about 20 minutes over, and I do apologize. We covered a lot of information, and I know it's a lot of numbers, and you saw a lot of structures. But again, you know, I stayed mostly with the calls today, but the same rules apply for the calendar puts. When you review the webinar, you'll be able to see that, yeah, if I'm doing a horizontal with calendar puts, sure. I still want to be selling at the money and buying at the money, and I probably want 2 or 3 right cycles. Same kind of structure. You've got to make sure your structure matches your goals and your expectations for the trade. Okay, your expectations for the stock and your goals for the trade. I don't care if you run a search on PowerOptions or another service and you see a potential calendar spread on a stock you were following and it shows you a potential 100% return. If you're bullish on the stock and it's a horizontal spread, that's no good. You don't want the stock to go up, okay? And again, I know there's so many different combinations, and I'm sorry I don't have the one answer for you. I did give you some answers today as far as diagonals. I want at least 3 right cycles, minimum. I want a delta ratio of at least 1.6 when doing a diagonal. I'd like an IV ratio of greater than 1, and 99% of the time I will find that. And I want to make sure that the net debit is less than the difference in strike prices. Those structures alone give me a reasonable setup, but what stock criteria am I looking for? The same exact ones I'd look for in a covered call, a bull put credit spread, a standard collar perhaps. It's a neutral to bullish position. I want to look for stocks that are neutral to bullish as well for a diagonal calendar call spread. Reverse diagonal calendar call, you're going to look neutral to bearish. You're going to look for stock criteria that are the same there as well. Now, as I mentioned, to follow up later on, we will post this archive this afternoon. I will let everyone know when it's available. Also in that email to let you know the archive is available, I'll have a link to register for next week's presentation. I'm sure we'll do it. We'll go more in depth into some of that criteria I just reviewed on stock selection, strike price selection, and direction as well as some further comparisons on the structure. And then the week after that, knock on wood, barring any minor major changes that might be coming up in my life in the next 3 weeks, we will look at the calendar spread management. Okay, so that's what's coming up for the next 2 weeks, and I'll send you a link to register for next week's webinar on more talking about the criteria and option criteria and stock criteria for calendar spreads, and then we'll look at the management further on. All right, well, if you think of any questions later on about today's presentation or in general, send us an email to support@poweropt.com. Remember, you can also call us during market hours at 877-992-7971. Or if you live outside the continental U.S., you can reach us at 302-992-7971. Also want to remind you, unfortunately, I'm not going to be available for the next 15 to 20 minutes, so if you call the next 15 to 20 minutes, I might not be available. You might get Ernie. And remember, if you haven't done so yet, you can always take a 14-day free trial at PowerOptions. We just showed the custom spread tool today. But just go to PowerOpt.com, put in first name, last name, email address, and then, of course, you'll be able to access the tools for 14 days for free, no credit card required. Well, ladies and gentlemen, thank you again for joining me. I hope you got a lot of information out of this presentation. I hope to see you all next week, and I'll let you know as soon as this webinar is posted. Take care. Good night.